Good day, everyone. The event will begin shortly. We are waiting for all our guests to join the event. Be right back with you. Good day, everyone. My name is Zikant, and I would like to welcome you all to KiwiTech Fireside Chat. I am super excited to be here with you all today as we delve into a very important topic. It is 2023 credit and VC funding environment after Silicon Valley Bank. In this fireside chat, we will explore the impact of the downfall on the credit and VC funding environments and discuss if this will lead to a domino effect as it happened in 2008's recession. We have two distinguished speakers with us today who will still shed light on this topic and share their insights with us. Before we move on to the discussion, let me tell you a little bit about KiwiTech. We are an innovation ecosystem that's home to 500 plus portfolio startups and 300 plus mentors, and we are committed to supporting innovators globally. We team up with early to late stage startups to help them navigate through challenges and reach their next growth stage. Our startup program provides entrepreneurs with 360-degree support in terms of technology, fundraising, mentorship, and go-to-market strategy. And our founders have a successful entrepreneurial track record, having exited a publishing services company in 2012 after scaling it to over 5,000 employees globally. Now, for the audience, you can share your questions using question and answers or chat feature in the Zoom window below for our speakers after the discussion. So without further ado, I would like to introduce our speakers to you now. First up, we have Barbara Matthews. She's the CEO and founder of BCMstrategy. Barbara is a globally recognized public policy and quantitative finance leader. Her track record of successful innovation and founder leadership includes building teams, chairing meetings, delivering speeches, and negotiating consensus-based agreements in 5 continents. She's currently the founder of BCMstrategy, which is a KiwiTech portfolio company that helps portfolio managers and advocates make faster and better data-driven decisions regarding public policy trajectories. The company uses award-winning patented technology to measure public policy risks by converting official sector words into objective momentum measurements. In government, Barbara had the honor to serve as the first US Treasury attaché to the EU. As such, she was the most senior Treasury official in Europe. She holds one political degree from Georgetown University and 2 law degrees from Duke University Law School with honors. A member of the Bretton Woods Committee and Council on Foreign Relations. She's also a non-resident senior fellow at the Atlantic Council. And our second speaker is Ike Syed, who is a senior vice president of strategic partnerships KiwiTech, where he leads the enterprise and SaaS engagements within the startup community. Before KiwiTech, Ike served at the US Department of State in 2 consecutive administrations, where he advised the senior leadership on economic impacts of foreign investments, digital economy, and emerging technologies. Prior to entering public service, Ike worked as a management consultant at Oliver Wyman and a finance executive at Fidelity Investments on Wall Street, where he advised corporate leaders globally on critical strategic and business issues. And as an experienced veteran of the tech industry, Ike has led product development and technical research initiatives at Cisco Systems in Silicon Valley and Bell Labs in the past. Ike received his Bachelor's of Applied Sciences in Electrical Engineering from the University of Waterloo in Canada and MS in Computer Science from Boston University. a licensed professional engineer. He obtained his MBA from MIT Sloan School of Management. So the screen is all yours, Ike and Barbara. Please share your thoughts on the fallout of Silicon Valley Bank and its impact on overall startup funding ecosystem.
Hi, Ikan, can you see me and hear me?
I can see you and hear you. Yes. Thank you.
Perfect. Well, good morning, folks. Good afternoon, depending on which part of the world you are dialing in from. As Ikan mentioned, my name is Ike. I'm the Senior Vice President of Strategic Partnerships at KiwiTech. Super excited to be joined here by Barbara Matthews, one of our star portfolio companies, also based in Northern Virginia. We'll be talking about quite a few things today. We'll be talking about Silicon Valley business model. What are the implications for early stage VC investments, credit intermediation, language-derived data, as well as doing a deep dive on what lies ahead for crypto, as well as stable coins for our friends who love Bitcoin. So let's just dive right into it. I'm just really excited, Barbara, to hear your thoughts and views. Obviously, both of us have backgrounds in government, but as well spent a lot of time in the private sector, in the venture capital space, running our own companies, and being involved in the ecosystem. So for over a decade, we saw how low interest rates allowed VCs to accumulate really large funds to give increasingly and sometimes very unprofitable company startups which had very unrealistic business models in some cases with, pretty insane valuations. There was a 2021 analysis which found that not only were 90% of US startups that were valued over $1 billion unprofitable, but they would probably continue to stay that way for the foreseeable future. And so, we saw what Silicon Valley Bank deposits went from $62 billion in the end of 2019 to $189 billion by the end of 2021. So let me just dive right into it. Can you share with us a little bit more specifically what the Silicon Valley business model is and how they work?
Thanks, Ike, and it's great to be here with you. I'm looking forward to this conversation as well. And I'm really glad that you started with the interest rate environment because it's a crucial component of the story. It is universally true that when a bank goes down, the problems didn't materialize overnight. It may feel like that in the middle of a bank run. These are not overnight problems. So really, the funding environment started changing last year, when the Federal Reserve and all the other central banks globally started raising interest rates. And so the funding model for startups was already difficult. Add to that the geopolitical situation with Ukraine and with China, and the venture capital community was drawing back. And I think we probably should at the back end of this talk a little bit more about what happens in the value chain within the capital structure when exits become difficult. But for the moment, I want to answer your question about Silicon Valley Bank. So their business model, so everyone's seen in the press, it's described as a startup bank, and that's certainly how they marketed themselves. But if you really look at their business, their model was they were the banker to the venture capital community, with ambitions to be the venture capital bank globally. So they had offices in London, for example. And what does that mean? So that means that they had a large number of highly concentrated depositors, the wealthiest people on the planet. And this becomes very important because when a bank fails, part of the way that the regulatory structure keeps confidence in the overall banking system is to say, don't worry, you will get your money back. We have insured, and it's not the federal government, by the way, that insures the deposits. The banks themselves pay a premium every quarter. So there's an insurance fund, but the problem is that there's only so much insurance, and the limit on insurance is $250,000. So the bank's business model was, mega VC firm, uber wealthy person here. You put your money on deposit with us. And then you do all your financing with your startups through us. And you have your startups also be in our bank. So your startups pay their payroll through our deposit window and through our payment structure. And all of that worked really all right until two things happened. One, interest rates started going up. So in a bank, the deposit is the liability, it's not the asset. A bank typically covers its liquidity risk, the risk that a depositor will request their money back immediately, usually by, and these are regulatory standards, by holding what are called high quality liquid assets, HQLA. And by the time you're done with the technical definition of HQLA, it is a sovereign bond. It's a US Treasury bond, 10-year. So Silicon Valley Bank got hammered twice. It got hammered once with rising interest rates because the VCs were not able to exit their companies. And so they were stuck and they were looking for their own liquidity. And then they were hammered a second time because this year, when separately regulatory restrictions on the crypto space started constraining access to credit specifically for crypto companies, and many of the Silicon Valley VCs are deeply, heavily invested in the crypto space. They needed their cash to cover the inability to access their, Bitcoin, Ether, yada, yada. So the bank was seeing deposit outflows well before things got crazy. And how does a bank usually cover that? Well, they cover that by selling their treasury securities. And this is the third way that Silicon Valley Bank got hammered. When they purchased their treasury securities, interest rates were lower. Now that interest rates are higher, those treasury securities didn't have as good a valuation because they carried a lower interest rate. So the value of their available for sale securities plummeted. On the week that they, the actual sequence was on the Wednesday, a crypto company announced it was declaring bankruptcy. Wednesday and Thursday, Silicon Valley Bank started liquidating its treasury securities. Thursday into Friday morning, the VCs panicked. Now, imagine, I'm sorry, I'm a startup company, I shouldn't be making fun of the situation, but the reality is that these are very wealthy people, and yet they panicked and they demanded their money back, and that's what caused the bank run. That's what caused it to fail. And by the way, there isn't a lot. So I've told you 3 to 4 reasons why they went down. Of those, only one is related to their business model, being the banker to the VCs. The other 3 are absolutely still an issue for every bank currently. So I can stop there before we talk about the rescue and what it means for the credit supply chain.
No, let's go into that, and I'll hold my question till you describe kind of how the rescue happened and kind of what are the fallouts, and I'll hold my question. So go ahead, Barbara.
Okay. All right. So a bank run happens on Friday, and the federal government did. We'll just kind of go through the chronology because it's helpful. So the federal government did 2 things. People forget they also closed Signature Bank on the East Coast in New York. And Signature Bank was a big bank, and it had almost all of the same risk factors: a concentrated depositor base, most of which was uninsured, recent significant losses in their portfolio, recent significant portfolio outflows. They weren't so much concentrated in the startup space. They were concentrated in commercial real estate and crypto. They were a 24/7, 365 payment chain for the crypto system. And so when any bank fails, the FDIC comes in and the regulators come in, and they try to arrange what's called a purchase and assumption transaction. They try to get somebody to buy the bank. Typically, The playbook is you swoop in at 4 o'clock on a Friday. You work nonstop over the weekend. On Monday, you open with a new bank and a new buyer. This did not happen. They couldn't get buyers for Signature and Silicon Valley Bank. And in the end, and this is why we're talking about crypto at the back end of this webinar, in the end, although new companies were, new banks were found to acquire the assets of Silicon Valley Bank and Signature, they did not acquire the crypto-related deposits. So crypto is one of the major segments of the startup ecosystem that's really going to be adversely impacted in this very significant way. You know, technically, ironically, you know, think about crypto people that are very much into crypto really just can't stand centralized authority and view the government with great suspicion. They now have their deposits with the Federal Deposit Insurance Corporation, a U.S. government entity. There is no buyer inside. They're banking with the U.S. government. They can't be happy. Anyway, I digress. So that is kind of the anatomy. The other thing that the Federal Reserve and the Treasury did, which is massively important and which people do not focus on enough, they created this thing called the Bank Term Funding Program. So you'll remember we talked about interest rates and how the interest rates really have dramatically bad, technical term, dramatically bad impact on a bank's treasury holdings. And of course, if a bank is looking for liquidity, it has to sell them at a loss. And if enough banks do that, then we don't have a banking system problem. We've got a sovereign fixed income problem for the globe's reserve currency. That is a very bad scenario, very bad. So what they did was they set up this bank term funding program that de facto, it basically tells them, it tells the banks, do not sell your government bonds, don't sell your treasury, don't do it. You hold on to those securities, pledge them as collateral, and we will give you cash. You don't have to pay it back for a year. We will help you. And so what that does is it stops the run on the treasury bond market, which is more significant than a run on the banking system. Plus, it helps secure the access to sufficient liquidity to shore up the banking system itself. The Bank Term Funding Program utilization rates have been skyrocketing every week. The data is released once a week. Every week it has skyrocketed. We are nowhere close to, in fact, we're close to the limit, I think, of what they set up originally. And it's supposed to sunset at the end of April. So fast forward to one of the consequences in monetary policy, everyone's saying, oh, is the Fed going to raise interest rates again? Now that we've got a secure financial system again, there's no systemic stability, there's no bank runs. And I'm looking at the Bank Term Funding Program utilization rates, and I'm thinking, you know what? You've purchased stability. And I think the big question is whether they extend it past April. So I don't think we're out of the woods yet. At the start of this webinar, the question was asked, are we going to see a 2008 domino effect? I will tell you it's too soon to say. And the reason why it's too soon to say is that people also forget 2008 was a year-long event. Bear Stearns went down in March. I was actually the Treasury attaché at the time, so I was part of some of the discussions with the Bank of England and others in London to try to figure out how to, you know, duct tape the system together to keep it together. And we had a semblance of stability from April to September. And in September, of course, is when financial markets, the banks start figuring out, and companies too, they have to close their books. How are they going to close out the year? And if you're in the financial system, you do it in September, because if you're going to unload positions, if you need to sell some assets, you probably don't want to be doing that in December. So do we have a domino effect? I don't know yet. Lots of people are calling me all clear, and experience tells me we need to see those utilization rates go down in the Bank Term Funding Program. We need to see the other thing that they did. They created dollar liquidity globally through swaps with other central banks. Those utilization rates are also going up. every week this month. So I do a podcast once a week on monetary policy. Last week's was called Whistling Past the Graveyard. For this reason, we're, if we're very lucky, we will avoid 2008. That does not mean it's good news for the startup community, though.
Got it. Wow, a lot there to unpack. For Silicon Valley Bank, what could it have done differently? I'm curious. I mean, obviously,
we could spend an hour on that. Whole courses are going to be taught on that. I will give you some pretty basic ones. So Silicon Valley Bank is
some things are
not
out of their
an
control,
innocent
right?
victim in the whole thing. It's not just a victim of monetary policy. Let's start with the obvious. Every bank is required to have a chief risk officer and a risk team that imposes limits on risk taking. That's prudent management. The chief risk officer had left, I think it was 9 months before, and they never filled the position. That's one. Two, the risk committee didn't have a single banker on it. No bankers. Should they have invested less in government bonds? No, actually they couldn't, because the requirement, the liquidity coverage ratio and the net stable funding ratio both require all banks to hold government bonds.
Because they were the safest.
And then there exactly, and then there's and now we're going to get into why some people are saying there should be a criminal prosecution and investigation of what was going on, because the Federal Reserve did raise to them in 2022 that their assumptions and parameters regarding interest rate risk, their internal risk models, were not pricing in the impact of regular increases in interest rates, often to the tune of 50 basis points, which is a lot. And so they were not internally measuring the risk. So I will tell you, it would have been much better for them to actually have measured the risk and approach and taken it in a way that every MBA and every risk manager on the planet knows how to do. Even I could do that. And I'm not even a mathematician.
There was a piece earlier this week in Washington Post. I'll put the URL in the chat window for our attendees. It's a fantastic expose on how at Silicon Valley Bank, there was an internal model which showed that higher interest rates could have a devastating impact on the bank's earnings. And what the executives did was, instead of listening to that, and making adjustments, they just changed the model's assumptions. And with those tweaks, essentially, what that ended up showing is that, hey, interest rates will have minimal impact on their earnings. So it's just a fantastic piece, and I do really hope that there are criminal prosecutions and there are people.
And it helps explain why so many other banks. I mean, there was a scare about Republic Bank, but it helps explain why so many other banks are not in the same kind of trouble, because they do have risk committees, they do have proper internal risk measurement systems. So this isn't part of, I come from the banking space, so it's going to sound biased, but I will tell you, they needed a couple of old school bankers. I'm coming back. Their business model was they were the VC bank. They were top heavy with the VC perspective that cares about liquidity, cares about exits, cares about getting out. Bankers think differently.
Sure. No, absolutely. And again, as the discussion goes on, folks, I'll be putting interesting URLs in the chat window. If you have any thoughts, please feel free to share them on the chat window. We will be opening it up for Q&A, as Ikan had mentioned towards the end. But in the meantime, please feel free to share your thoughts in real time. So, Barbara, I'm just curious, kind of what comes next from here. If you look at, whether it's language-derived data, I mean, how can models like that identify the next, potentially Silicon Valley Bank type failure or other economic events in advance?
So That's a great question. There's a couple of different answers to that. Financial institutions do this already. Most banks, not community banks exactly, but most banks are publicly traded companies. So their financials are publicly available. So all you have to do is look at their balance sheet, look at their liabilities, look at the term structure of their liabilities and their assets. And, can you use any kind of machine reader, whether that's for the numbers or the words or both together, to identify when management is cutting corners or taking unacceptable risks? Yeah, I mean, apparently the issues at Silicon Valley Bank weren't exactly magical. So on the one hand, kind of industrial strengths, acquisition of data and automated analysis of data can absolutely help an investor identify early. And if you're inside a regulator and you're therefore accessing all this non-public information, a regulator can be ahead of the game. And in fact, the Fed was. They were looking at this, months before it was public. You could ask why they didn't take, and apparently they also, and I heard this in the testimony, bankers ignored the Fed, which is just mind-boggling. They received very stiff letters that usually have bankers shaking in their boots and running around to fix the problem. Silicon Valley Bank got multiple letters like this, and they ignored all of them. So I don't think there's a system that can help identify that specific management failing. But identifying anomalies in risk profiles and holdings and liabilities, absolutely. On the language side, there's another use case, and this one is familiar to us because we do this a lot. So our company, as you heard in the intro, we convert words into numbers so that we can measure momentum and see spikes in volatility and see anomalies in activity. And the language that we collect is public policy language. And we've been collecting that language for 4 years, especially in the crypto, stable coins, central bank digital currency, DeFi space, 4 years. So when our system flagged for us on the first working day of the year that the Federal Reserve and all the other federal banking regulators had a joint statement that was very hostile to the cryptocurrency business, which was important at both Signature and Silicon Valley Bank for different reasons, we noticed. And in fact, it was our inaugural issue of our Chain Reg podcast on Substack. And when additionally, in fact, I'm gonna drop that into the chat so that people can see it and you can listen to it. It's just about 15 minutes. So, and then on top of that, in March, our system showed exceedingly high volume levels of it showed exceedingly high volume levels for stablecoin policy across the planet. And that was striking to see. In fact, that podcast was called the day that everything changed, or the week that everything changed, because it was that dramatic. It was the language tells you when policymakers are moving in a direction that's going to have an impact on an entire ecosystem.
Got it. Now, how have investors been looking at startups such as yours that are working on language-derived data model? We obviously hear a lot about ChatGPT. We hear a lot about other advances. You were obviously way ahead of the curve, working on it for quite a while now. How are you seeing investor reaction?
Yeah, and that reminds me, I didn't answer your other question, the funding environment in general for startups. Okay, so the funding environment is going to be ugly. Let's just start with that. Liquidity has dried up in the funding community. Everyone is worried about not only the next shoe to fall, but as discussed, really since last year, when VCs can't exit companies as quickly as they would like, they don't have the funding to invest in other companies downstream. So it's going to be a challenge. There's a silver lining here. Companies at my stage and below, so that's pre-seed, seed, basically anything underneath Series A is going to do well. And the reason for that is that the funding there doesn't rely as much on valuation. Once one does a price round Series A and up, a number of very aggressive targets are made about revenue growth, expectations about the hockey stick exponential growth within a fairly short period of time. And so those companies that signed those contracts took that money and now need to perform against those benchmarks. They've got trouble because they are doing business in a slowing economy. And it doesn't really matter what sector they're in over the course of the next year, because we're going to see a contraction in credit, both from Silicon Valley Bank, but more importantly from rising interest rates, because that's what the Fed wants. The Fed wants less credit. The Fed wants less economic activity. They want to slow everything down. Those Series A, Series B, Series C companies, they're going to have a really hard year. There are a couple of really good places to be. And any one of us involved with large language models, training data for machine learning and artificial intelligence, that is a good neighborhood to be in. And we should all be sending OpenAI a thank you note, because both on the customer side and on the funding side, it is very clear that where there are limited dollars to be spent, this is the spend that will be prioritized. And that is a very good thing. So there are the other silver lining. I have not experienced it. I'm about to experience it, but I understand from other investors and mentors. The companies that know how to navigate this year will be very strong companies. So a lot of the kind of the crazy non-profitable companies that you mentioned before, they'll have a harder time, and I'm not sure that's a bad thing at all. I don't know if you wanted to say anything else about the very specific way that the valuation and the time horizon for exit can impact, because I know with your MBA specifically, you probably have a much better description of how that works than I do.
No worries. And we only have 10 minutes or so left, so I do want to cover a few other topics quickly. Moving on to crypto and stablecoin, because that's something that our attendees indicated that, just a lot of interest in learning more about, whether it's holders, minters, intermediaries, or custodians. Kind of, again, in light of what happened in Silicon Valley Bank and these rising interest rates, what are some of the challenges that you see for cryptocurrency and stablecoin?
Well, to start with, it's a hostile regulatory environment, no question. And it was going to be hostile even if Silicon Valley Bank didn't go down, and Signature too. So the combination of there being less liquidity and a heightened degree of regulatory concern, and also a heightened degree of geopolitics risk, all of those mean every bit of this business from across the value chain, across the supply chain, is about to become harder. And people sometimes say, well, why do you include geopolitics? Well, there's a heck of a lot of mining that happens in Russia, and there's a heck of a lot of mining that happens in China. And we are currently on track to be seeing very deteriorating sets of geopolitical relationships with China. And, just when you think it can't possibly become worse with Russia, it does. So the national security complex that sees the crypto business specifically as really a backdoor into the legitimate economy for money launderers, terrorists, thieves, it's, every black hat you can think of. They are on heightened alert. In addition, the central banks are in pole position over the course of the next 2 or 3 years to launch their own digital sovereign currencies. So up to now, the minters, even the custodians, certainly the intermediaries, it's been kind of a wild west from the perspective that there's not really been a lot of competition. The competition has maybe been between Bitcoin and Ether, but some people would even say it wasn't even really a competition. Or Bitcoin and Circle, but Bitcoin with Bitcoin people would say, well, that's not a competition because Circle's stable coin is tethered to the dollar, so it doesn't count as even a crypto. Everyone, stable coin issuers and cryptocurrency issuers, are going to see a lot of competition for the first time from central banks. So they're going to be in a competitive environment in ways they haven't been in the past. There's a lot of analysis out there that says that cryptocurrencies are a good hedge against inflation. So in a rising rates environment, you've got to balance out the value proposition associated with being an inflation hedge against the increased regulatory risk. It's going to be an interesting year, no questions. That's going to be harder though.
Got it. There was a great piece earlier today in CoinDesk magazine. Again, I'm going to put that in the chat window, and just a fantastic analysis on if Circle's USDC had been as opaque as their competitors. Probably no one would have known that Silicon Valley was the banker, and the run on USDC could potentially have been avoided. So
think about this though. This is a great detail point in the craziness that happened that week that Silicon Valley Bank went down. Circle's stable coin broke the peg to the dollar. And the only way they got the peg back was when the federal government said that they would provide 100% coverage to all the depositors at Silicon Valley Bank and Signature Bank, well beyond the insured limit. So the United States government took the decision to bail out not just depositors. And by the way, they were very good on the PR front. Silicon Valley Bank's PR was amazing. They were fielding these little tiny startups. Oh, I can't make payroll. But what was really happening was that the likes of Peter Thiel and Elon Musk and Circle, the really big depositors, were not going to trigger a run on the dollar through the back door of the stable coin issued by Circle. That's a very big deal. For as hostile an environment as it is, the minute that it touches the dollar, whoa, they came to the rescue. We cover this every week. So every week I look at so we generate data, like I said, on crypto every single week. And I read it because I care about it. I think it's super interesting. And every Friday we do a podcast. And in fact, I've got for all of our ecosystem here, I created a special discount for KiwiTech. So I'm going to drop that into the chat right now.
Please do. Please do.
If you care about, I did one for the cryptocurrency. So this is the link to get to the discount for the Substack on cryptocurrency, and you'll see that's chain reg right there. And if you care about monetary policy, I'm just going to drop that into the chat too. Basically for less than you would spend on a cup of coffee in a month or lunch in a month or a week, give us 15-20 minutes, I read the data. And this is important. This is another use case for language data that people don't fully appreciate. Everyone thinks that in order to engage with language data and advanced technology, you've got to be a technologist. You've got to have a computer science degree. But there are entry points that that effectively a retail user can benefit from the data in a completely different way. And so we're just making the data available to everybody through Substack. But if you want If you want to use a dashboard, if you want to use APIs, that's an enterprise business case, and it's completely different pricing. But we think it's really important because, what policymakers say matters. What a central bank says about distributed ledger technology, blockchain technology, that matters. These people can get up and make a decision that's going to change the trajectory of an entire industry. So we think it matters quite a lot to pay attention to what they say. We translate it into plain English so that people can understand it. This is the other part of transparency that a lot of people don't get, is that, yeah, there's a ton of information out there, but if it's all in technocratic language you can't understand, it's not terribly transparent. We make it transparent.
Got it. So this is obviously a very complex ecosystem. You have your holders, minters, intermediaries, and custodians. If you had to look among all of them, who do you think will be the most impacted by what's happening?
That's a good question. I actually think the custodians. I've seen that some major institutional custodians like State Street and NASDAQ are in the wake of Silicon Valley Bank looking to become custodians for cryptocurrencies, not even stable coins, just cryptocurrencies. So if you're if you're not prepared to compete with a company like that, you've got a challenge. And the other reason why I think it's massively important from a strategic perspective, once you start entering this universe of professional intermediaries, a couple of things happen that are very important. The first of which is that these entities are gateways to fiat currency, to sovereign currencies. So it's going to intensify the competition among different types of digital currencies. But the other thing that happens that is less obvious, every one of these companies has professional risk committees. Valuation for all the cryptos at this stage, especially the cryptos, has really been a social media sentiment play. Entire bots have been created to, firestorm Twitter and impact and do what used to be called a pump and dump scheme in the securities business a long time ago. But since crypto is not a security, we were perfectly able to do that. When you start having institutional players that hold portfolios and have risk limits and have risk committees, they start looking for data that supports a risk profile. They start defining the risk profile based on fundamentals, trading patterns, risk parameters. That's going to change how cryptocurrencies are priced, how people view the intrinsic value. That's going to play out over a period of time. And that's not a regulatory issue. That's just a plain old business issue. If you've got a hedge fund that is holding a fairly significant portfolio of crypto, they are not going to value their risk in relation to the social media sentiment of the day. That may be something they look at, but that's not their real risk. They know it. They know how to measure risk. Pricing is going to change. I think it's going to take like 5 years.
Wow. Okay. We're coming up on time, less than a minute to go. Final thoughts for our audience members, attendees?
No, I actually think it's a great time to be a startup with a serious business. Because I think the competition from the crazy connected frat boys, they're going to have a harder time getting the money. So someone who benefits from the extensive mentoring that the KiwiTech, for example, provides in the ecosystem, someone who really listens to the training, pays attention to the business plan, pays attention to the revenue model, that's a winning strategy. So don't be afraid. Keep an eye on it. We hope our Substacks can help you keep an eye on monetary policy trends, crypto, if you're in that industry. But honestly, I'm very optimistic about what the year holds.
Fantastic. Wonderful. Thanks for those kind words, Barbara. Thanks for sharing your thoughts so candidly. Let me turn it over back to our moderator to see if there are any questions coming in on the Q&A, if there are any other house rules or any thoughts that they want to share. We can.
So thank you for that chat, Barbara and Ike. That was really insightful. It is great to have these conversations when there are so many speculations in the market. So we all need that transparency. And we will now, yes, move to the question and answer session. And for our audience, you can share your questions using Q&A or chat feature in the Zoom window below for our speakers. We will wait for just a few seconds. Thank you. So I think we have our first question, like, says, did policy scope data help anticipate the problems that led to Silicon Valley Bank's collapse? What is it telling you about monetary policy trajectories right now?
Great question. In fact, we took a bit of a victory lap recently. We used language data to make the case correctly that policymakers would raise rates at their last meeting. I'm going to drop that into the chat here. And what does it tell us about where they're going next? So we're only 1 week out. This is the one from before. We're only 1 week out from the last round of monetary policy sessions. We don't have enough economic data yet. But what I will tell you is the language data so far, in fact, maybe I'll drop in last week's. The data so far is telling us that they actually really want to raise interest rates. They are being very, very clear and consistent in their language regarding inflation. But weirdly, they're being outrageously silent about financial stability. And they're not talking about any of the utilization rates I mentioned at the beginning. So my personal indicator, I think, if utilization rates go down for the bank term funding program, they will raise rates. I think that if they extend the bank term funding program, they will raise rates again. With public policy, and this is a very detailed technical point, 0 matters as much as a positive number. And when they're being really silent on financial stability, despite the data showing the utilization rates, that's a signal all unto itself. We talk about that on the podcast. Today's Wednesday, do the podcast for monetary policy on Sundays. I don't know yet. I want to see what they say on Thursday and Friday before I decide what direction they're going in. And someone else might read it differently. So we help people navigate the thicket of all the noise, and we actually strip out a lot of the noise so that people can see what they're really saying.
Thank you. We really appreciate for that. I think we have our second question. Ike, you may want to take that up. It says, how is policy scope different from Bloomberg GPT that was released last week? And either of you can answer as you deem fit. Yeah.
Oh, that's all Barbara.
Well, that's super easy. Although I thought that was super interesting that they did that. So the way to think about any of the chat or large language models, they are basically a glorified research assistant that does the analysis for you, stitches it all together. My policy scope data is the training data. So in order for any GPT to provide you with an answer, they have the machine has to read a lot of documents. That has to learn And it has to learn from a lot of language. The benefit to using policy scope data is that we have curated and we listen intently and thoughtfully, automatically, with patented technology, only to the language that policymakers say. There is no noise in our data. When looking at public policy, the temptation is great to get any data you can find on Twitter, on Reddit, on blogs, or a bunch of people that maybe don't even know what they're talking about. We only focus on the language of the people with the authority to make a decision tomorrow. And then our media inputs are the best fact-checked, high-quality journalism on the planet, namely Dow Jones and Thomson Reuters. So it is actually superior training data. Do I think Bloomberg should be using our data to train their GPT model when it comes to monetary policy? Absolutely, I do. I need to figure out how to find the right person to make that case though.
Great. Thanks for answering that, Barbara. I believe that is all we have for today. With that, I would now like to close the event. Thank you, Barbara and Ike, and the guests who registered for today's Fireside Chat. I hope the event was well worth your time and you had as much fun as we had bringing it to you. I would like to bring your attention back on the screen for our upcoming events. We host these events on a weekly basis. We hope to see you again at some of our virtual events here. Till then, take care and stay safe. Thank you, everybody.
Thank you.